Hello, I'm David Frazier, aka the Market Monk, and this is our daily Market Monk show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to affect your investment portfolio. Well, I'm recording this show, by the way, on Saturday, September the 27th. I would normally record the show on Friday. We generally present these shows on Monday through Friday of every week. Having said that, there was a lot of hoopla that I heard on the major financial news networks on Friday of this week regarding the surge in GDP, that is gross domestic product, and the extent at which the GDP report was, according to the folks on these financial broadcast shows, was very, very positive, and that the pace of economic growth had picked up substantially during the second quarter of this year. Well, let's talk about that a bit. First of all, my guess is a lot of you that are listening and watching this show might not be aware of the following fact. And that is, regarding the quarterly GDP reports, the gross domestic product reports, that is, reports on the total output of goods and services in the United States. These reports come out every 4 times, they come out every quarter of the year. First, there's an initial estimate of gross domestic product for a given quarter, then a revision, a second revision, and finally a final revision. And whenever you hear folks, at least other than me that I know of, talk about the GDP report, when they talk about the growth rate of the economy, the extent to which the economy grew or worsened, they're not really in talking about the actual rate of growth. What they do is they first of all of the figures that come out on gross domestic product from the U.S. Department of Commerce are they're seasonally adjusted to begin with, and that's a good thing to do because we generally have more economic activity during certain periods of the year than we do in other periods of the year. So it's not that this is a bad thing, but I just want you to know what these reports are actually telling you. What they mean, I should say. So first, the figures are seasonally adjusted. Then they use a mechanism to account for changes in the price levels of a broad basket of goods and services in the economy. So that's the second thing they do. And then once they do that, the government will present certain figures regarding the changes in GDP, which you could do yourself if you had the data. And when you hear most so-called financial market experts, as well as rather esteemed economists, talk about the change in GDP, the figure that they'll almost always state is as follows. They'll look at the total output of goods and services in the current quarter. They'll compute the difference from the preceding quarter, and then they'll multiply that times 4. So in other words, they look at the extent at which GDP changed in the current quarter versus the current quarter, and then they'll annualize it. That's why they multiply it times 4. And that's the figure that they'll state to you, which I have always found is to be just a bunch of nonsense. I've said what I'm about to say in just a moment here before on this show, and that's as if I measured the height of my daughter, who's 11 years of age, today, measured her height again next month, and let's say, for example, that she happened to have grown 1 inch during that 1 month period. Well, if I did how these stock market and economic professionals talk about the change in GDP, I would then take that 1 inch and multiply it times 12 for 12 months of the year, and would assume that she was going to grow a foot in the next year. And of course, that's a complete bunch of nonsense. Why would we annualize just 1 quarter and then annualize and then assume that the economy's going to continue to grow at that rate? Well, we wouldn't if we were thinking logically. That's just nonsense. And so, having said all that, I hope I didn't bore you. The annualized rate of change in GDP, that is the pace of economic growth, in the second quarter of this year, as compared to the first quarter, multiplied times 4 annualized, the economy grew at a 4.6% rate. You know, if that's the actual rate that the economy were to grow every quarter, that's a pretty darn fast rate, and that would be very, very positive. But that's not what happened. It's you know, we annualizing that once again makes no sense. So what I prefer to do, and what I do, you know, I always look at these quarterly changes, but I want to know the rate at which the economy actually grew in any given quarter. So what I will do, and the U.S. government does it also, it's for some reason they just don't talk about what I'm going to tell you generally, I will take the change in GDP in any given quarter and then compare it to the same quarter a year ago to get the actual change for that quarter. You know, not this nonsense annualizing out into the future. And what we found, what I found, and what you would find if you did that, is the economy actually grew only 2.5% during the second quarter of this year, as compared to the same period a year ago. Now that's still not bad. It's a fairly healthy growth rate, but it's obviously nowhere as positive as that 4.6% rate that the folks on these broadcast financial shows talked about. And there's something else that's important about this. That 2.6% rate, even though it's a fairly healthy rate of growth, since the last economic recession ended, in government terms at least, during June of 2009 through the second quarter of this year, the U.S. economy has grown at the slowest pace during that entire period during any other economic recovery since at least the year 1916. And the reason I know that is I went back to the year 1916 and just looked at all other recoveries and the pace at which the economy grew during those periods. And during no other period, going back to 1916, has the economy grown at a slower pace than in what it's grown during this current recovery. Now, I would have even gone back further than 1916, but there wasn't any reliable data that I could get a hold of to go back to that period. So, the reason I'm bringing this up is, you know, you oftentimes have these folks on these financial shows. You know, if the stock market is down big in any given day, like it was last Thursday, it's like the world's coming to an end. And then when it's up fairly by a pretty fair degree, then everything's great. And what I am finding is that neither of is the case. Now, I'm not one of these gloom and doomers, and anyone that's known me and has read my market commentaries and my financial newsletters and listened to me on my financial shows, the Market Monk Show, know that you know, I'm not a gloom and doomer, nor am I a perennial bull. I just go with what the data tells me. And I could talk about that and give some examples, but I don't want to waste your time. You know, I have very specific examples of where I've been very, very positive because the data was positive, other periods where I've been very, very negative, and other periods where I've been kind of in between. And that's where I am right now. I'm not overly positive because the data is not overly positive. I'm not pessimistic because the data is not overly pessimistic. But overall, you know, more than 100 economic indicators that I look at every month for the U.S. alone, and then approximately 75 other indicators that I look at for other countries around the world, indicate very strongly that there's not really any significant catalyst to suggest that economies around the world will continue to improve or that the pace of economic growth will pick up over the next several months, nor that stock prices are headed substantially higher. Yet at the same time, the same data does not indicate in any way that stocks are about to fall sharply. However, having said all of that, there are some indications that the best course of action right now for stock market investors and speculators is to take a bit of a cautious approach. And for example, just looking at a few statistics here, if I can find them. Oh boy, don't tell me I can't find these. I had these up on my screen, and now I don't find it. But that's okay. I'll find it real quick. Something I wanted to refer to. Boy, just give me a moment if you can, please. Okay. So, two of them I know right off the top of my head, and that is the employment market here in the United States has deteriorated somewhat during each of the past 2 months, meaning that the number of jobs created declined during each of the past 2 months. Well, that's obviously not a good thing. You don't want to, at least we have job creation, but we've had fewer and fewer jobs created during each of the past 2 months. So that's obviously not a good thing. Secondly, the housing market is showing signs of slowing. Now, some of you are going to probably think, well, I just heard that sales of homes were up substantially last month. Well, they were. But sales of homes is actually somewhat of a coincident and sometimes even a lagging economic indicator, meaning even after the economy is topping out, and I'm not saying that it is, you'll see home sales still go up for a few months. So, we don't want to pay much attention to that. What we should be focusing on are leading indicators for the housing market. And one very, very reliable leading indicator for the housing market is the construction of new homes. And the construction of new homes was down 14% last month. That's a pretty substantial pullback. Next, manufacturing activity. Even though it's been fairly strong over the past few months here in the United States, it's showing signs of peaking. I'm not saying that it is, but it's showing signs of peaking. If that turns out to be the case, it's obviously not a positive development, quite the contrary. That would be a negative development. Next, the Federal Reserve told us last week that they're going to continue to reduce their purchases of U.S. government securities, meaning that they're going to provide less stimulus to the economy in the form of the money supply and money that's available for lending and therefore borrowing or lending rates. And lastly, corporate profits look like they may have peaked during this phase of the economic cycle. Once again, I'm not getting overly negative here. I'm just saying these are some important factors to pay attention to, and they suggest that people that put money in the stock market should be a little bit cautious right now. And then if we just look at the trading action in the financial markets over the past few weeks, the cumulative advanced decline line, that is the number of stocks that move up in price on any given day, minus the ones that move down in price. Well, that the cumulative number has been falling for several weeks now, meaning that there's been more stocks overall falling in price than the number of stocks rising in price. If we look at the percentage of stocks that have traded above their 200-day moving average, a fairly long-term moving average, the percentage of stocks that have done so has continued to decline for about 6 weeks now. So we've got some cautionary things going on here that it makes sense to be aware of. So I think I've said enough, but mostly, as I've told our listeners before, look, I just go with what the data tells me. I tell you what you need to know based on my long-term experience in the financial markets, and I just tell you the facts. So I hope you got something out of this, and thank you for listening and watching, and I'll talk with you again this coming Monday. Thank you.